Hi guys, it's Chad Larson with MLD Wealth. It's June 1st, another edition of MLD Wealth Money Matters. Filming remotely today. Caught me all on holidays. I'm in beautiful Morocco here today. So for those of you watching on video, you can see some ancient village thing behind me, which I haven't yet to explore. Few things I wanted to talk about today and keeping it brief. A couple things and some more noise in and around the market and some client inquiries around the U.S. debt ceiling, potential Canadian housing bubble, strength of the Canadian banks, the energy markets, and just general positioning strategies and how we see the markets continuing to unfold. What I spoke about last month, in and around being congruent, that we expected the markets to be choppy in the front half of the year, and again into the latter half of this calendar year, the markets would likely discount a recovery that we see in 2023. Now we're off the back of the fifth straight week that the NASDAQ has achieved positive returns, largely the phenomenon of coming off of aggressive tax loss season, and the market's starting to bet that the market rallied last week because they believe the U.S. lawmakers would raise the debt ceiling. I think this is a bipartisan issue that comes to the table constantly and is used as political cannon fodder as, the Federal Reserve and the Congress sets the debt ceiling at which the U.S. can borrow money. So avoiding a potential shutdown of the government and the unintended consequences of delayed Social Security payments, shuttering government services. It always reads doom and gloom across the marketplaces, but no one party generally has gone so far down the path to dig in their heels. So it becomes whoever's in control of Congress and the House to be able to ram through some more political agendas from either side of the bench to get something done in the middle. And so McCarthy and Biden ended up reaching an agreement. So probably if I would have filmed this 3 days ago, I would have been talking about the pending resolution of this. So we do have resolution, positive impact into the market, so that's great. We had put more money to work last month, bringing cash weightings down. A couple things like in and around the discussion of deployment strategies and different sectors in and around that. Something unique and more relative to our investor base that's based out of Alberta, but across the board, our exposure to the energy markets and our short-term bearishness but long-term bullish positioning in and around that sector, again due to lack of investment long-term and sustainable energies, being non-cost effective and being able to take on full scale and scope. We elected a UCP government majority in Alberta, positive for the energy trade, positive for corporations based out of Alberta, as the NDP's platform called for a near immediate significant hike to corporate tax rates. So in the clear for now in that regard. With respect to U.S. housing or Canadian housing bubble, it's real and it's not. I think and that dovetails into two topics. One in the Canadian banks and the strength and stability of them. Something that we've been seeing for a while was what we were calling blend and extend. I won't call out any one certain bank, but already at a regulatory level, you're starting to see, mortgages that were coming for renewal that perhaps had, little equity in them. Prices have slipped. Interest rates are up. So whereby, X percentage would have been principal and X percentage would have been interest. Now you have a scenario where, the interest component of it alone is near higher than their old payment, and so as such these houses would be underwater and they would be potentially in distress. So you're seeing banks do blend and extend, and that is terming out and extending the amortization periods quietly and softly just to maintain integrity across those markets. The Canadian banking sector from a regulatory standpoint is very robust. What really affects a housing bubble is jobless rates and our unemployment numbers to a different fraction in that regard. It's creeping up. And like we said, we expected to see a very negative economic calendar into the end of the year with a positive market. The economy will get worse while the market does better. So it's one of those things where there's going to be more pain on the street, but from a portfolio standpoint, things look better to the turn. From the energy trade, obviously seen some strong year-to-date weakness, and some comments and conversations that I was having, which was unique, was, why are we not, why are people not loading up on these deep value names? And they've never been cheaper, and their balance sheets are amazing, and incredible free cash flows and strong dividends, while tech stocks are starting to rally again. Microsoft at all-time highs again, and Apple's run, and Nvidia reported strong numbers, and the stock surged. The weighted risk probability of a wild tech stock that's gone from maybe 50 times earnings, down to 20 times earnings, the odds of it going back to 25 or 30 times earnings are probably more probable than energy company going from 2 times cash flow to 3 times cash flow. And obviously the headwinds of the ESG phenomenon of clean, sustainable investing driven down by endowments, institutions, and all of that kind of stuff has kept these deep value trades. Will likely be deep value for some time, but we also find kind of solace in that. We find they're better sleep at night trades backed by real assets, real replacement cost infrastructure, real NAVs, real book values per share. So, you're not going to see kind of that resurgence or resubiance. And that's why you've seen the NASDAQ perform far better than the Dow, so to speak. But, sticking to our laurels and being deep value based investors generally over the long term aligns with our value set and the risk tolerances of our clients that are largely looking for capital preservation and modest growth over a market cycle. Other things, we've talked for the last couple of months about the SVIBs and U.S. banking crisis. That's largely seemingly past us, hasn't flared up. We haven't seen a lot more. Some interesting developments probably jumping back into the Canadian housing space and with respect to mix or mortgage investment corporations. We've done some structuring in and around private credit that's going to be thematic and take advantage of, I think, some weakness that you're going to see across the space. Going through into what feels like the summer. Again, this is the first time I've ever filmed remote like this from a foreign country, but it kind of feels like summer, definitely does here. Cash weightings will be flexed, looking to be opportunistic. Some of you have also kind of asked to kind of comment and update with respect to Canaccord's management-led buyout. For the time being, let the media kind of run its course, and we are a public company, and let the press releases of the company drive the information flow of that. So I can't comment on that for now, but stay tuned. And for all of you else, I would say, like all things, the news cycle has slowed down the volatility or the fear mongering, which has been welcomed and nice. And so you'll probably see some buoyed markets in through kind of the next few weeks of trading sessions, and then kind of decide what things look like through the summer. What pockets of volatility that are largely created by lack of volumes. Slowdown in capital markets activity, which quite frankly has been next to zero year to date. So I think it's going to be a quiet summer. When I talk to other institutions and hedge funds, it's still largely pens down. No one's doing a lot of things. If it isn't broke, don't fix it. But thematically, the building in the bedrock or setting the tones for the currents of the next running bull market. As always, thank you so much for the trust and confidence that you place in MLD and its team and in serving our private clients. And if you have any comments or questions or concerns, feel free to reach out to myself or anyone on our team. Have a wonderful month, and we'll talk soon. All the best.